What for you are the highlights of these results?
Well, the first highlight is undoubtedly the fact that we were able to grow the loan book by 30% at the same time as reducing impairment from 29% to 24%. That's quite unusual in lending, to be able to have expansion while at the same time being able to improve the quality of the loan book. The second point is that we actually took on 650 people, that is agents and employees, and opened 32 new offices. And then, of course, refer back to what had already happened at the half year, was the acquisition of George Banco and the complete refinancing of our debt facilities, more than doubling them. Those, to me, were undoubtedly the major highlights.
Now, what's behind the growth at Everyday Loans?
Well, Everyday Loans is an interesting market position. The clearing banks are more and more looking at restricting the risk profile that they have. Therefore, we get more customers coming to us. We, from our side, have opened 12 new branches in 2017, increasing our geographic footprint. All in all, that means growth has continued and indeed increased during 2017.
Is the rapid growth in loans at home sustainable?
Well, 2017 was undoubtedly an unusual year for loans at home. One of our major competitors took quite a major misstep, which resulted in some 550 staff and agents coming across to us. That was behind the 53% growth in the loan book. I would expect that in 2018 the growth will moderate to more normal levels.
Growth in your guarantor loans division has been driven by the acquisition of George Banco. Do you expect growth in future to be organic or by acquisition?
We have now established ourselves as the clear number 2 in the marketplace by acquiring George Banco and merging it with Trust 2. We do not need to make any further acquisitions. We have a formidable platform which is doing very well in a market that's got strong growth. So I don't anticipate further acquisitions in that sector.
With the proposed dividend, you've now achieved all your targets except a 20% return on assets. Should we expect any upwardly revised targets?
We thought about the targets very carefully at the time of our IPO. They were based upon many decades of operating in the sector. What we've done is actually to validate those targets. So I don't expect to see any revisions upwards or downwards.
So how do you view the economic environment in the near term for your customers, agents and operating companies?
Well, we're in an environment of very low unemployment and very high employment, which clearly benefits our customer base. Also, their incomes, and these incomes are those lower down the income scale, have actually increased due to the increases in minimum wage. We've actually seen them from our own research that their incomes have increased faster than inflation over the past few years. So they're actually in quite a good position. At the same time, they do not have a huge number of sources of borrowing, so generally they're also under borrowed. So our customers are in quite a good position at the moment.
And are there any regulatory changes expected to affect the business this year?
At the time of our IPO, we said that we understood regulation and where the FCA was going very well as a result of having run regulated businesses for many years. We therefore put in place quite a number of changes which were in anticipation of what we saw the FCA would require. That has turned out to be the case, so we don't see any material effect on the profits of our business as a result of any regulatory changes that are going to come through in the next year or so.
What balance of growth do you expect to be organic and how much through acquisition?
Well, what we see is that we've got in place 3 divisions which are all really well placed. They are all growing quite strongly. And so therefore we see most coming from organic growth. Now, acquisitions are always possible. We have a very successful track record in terms of acquisitions, and we continue to monitor possibilities as time goes by, but we have no immediate plans at the moment.
So what's the focus for the divisions this year?
The focus for the divisions this year, I'll take them one by one. So our branch-based lending business, Everyday Loans, is opening a further 12 branches, thus again expanding our economic footprint and taking full advantage of the market opportunities. Secondly, in Loans at Home, our home credit division, we see the bedding down of the very considerable numbers of staff and agents who came across to us, delivering a good level of continuing growth. And thirdly, in Guaranteed Loans, the final integration of the platforms and taking full advantage of the market opportunity. And we see that the market continues to grow at around 30% compound annual growth.
You're recommending a significant increase in the final dividend despite making a statutory loss. Can you explain?
Yes, certainly. The dividend actually reflects the underlying financial results of the company. The statutory figures contain a lot of non-cash items which are related to our acquisitions and do not reflect the actual underlying profitability of the business. So the dividend reflects the underlying profitability of the business.
You highlight the normalised results in your announcement. Why should investors focus on those?
The reported results include a number of non-cash items relating to previous period M&A and also exceptional items. So we back those out to provide normalised results, which we believe shows the operational performance of the business.
But would you continue to have exceptional and one-off items every year if you keep on acquiring companies, opening new offices and branches and taking on new agents?
Even if we don't acquire further businesses, there will continue to be non-cash items related to previous period M&A. So they'll continue to be there. We'll continue to reverse those out. We don't expect exceptionals in 2018, and the support costs for agents in 2017 will not be repeated in 2018 either.
So what do you think are the key highlights of the results?
It's that combination of loan book growth at 20% or above, so hitting our first key milestone, combined with lower or at least flat impairment. And we're particularly pleased with Everyday Loans and Loans at Home, our two biggest businesses, which have shown really strong loan book growth and falling impairment as a percentage of revenues year on year.
Now, whilst the impairment ratio at Loans at Home has reduced, it's still considerably higher at 31% than the other two divisions. Is this an acceptable level?
It's a very different business to the other two divisions. The loans are much shorter, the customers have lower incomes and are in truth more risky as people to lend to. The other measure we look at is risk-adjusted margin. So that's revenue less impairment divided by the average loan book, and that highest risk-adjusted margin is actually in our Loans at Home business. So we're happy with that level of impairment.
So what will be your key investments this year in the divisions, and what can we expect in return?
The key investments in 2018 will be in the further 12 branches in Everyday Loans. We've said that we have a commitment to get to a much bigger branch network, so we cover the whole of the UK, and we'll see that coming through in 2018, and that sets us up well to continue to deliver 20% plus loan book growth in Everyday Loans for the next few years, which is our target. Loans at Home saw substantial investment in 2017, adding over 400 agents and 22 branches. We don't see that repeating in 2018, so there'll be very little in the way of support costs to payment agents in 2018.
Do you expect to complete the share buyback in 2018, or might funds get diverted for an acquisition, for example?
No, we expect to complete the share buyback. We've already purchased nearly a little over 3 million out of the 5 million target, so we expect that to be completed within the next 3 to 4 months.
Now, you refer to the impact of IFRS 9. How should investors view this?
IFRS 9, first of all, to point out, it has no impact on the profitability of a loan over its life, nor the cash flows from that loan. So it's all about where do the profits fall. Because our businesses are all growing, that tends to move impairment forward under IFRS 9. So impairment we might have once recognised in 2018 in the first quarter will fall into the last quarter of 2017. Therefore, we'll see a step up in impairment as a percentage of revenues, and that will continue going forward. But as I said, no impact on profits or cash flow over the life of the loans. And in the presentation that we've made to analysts this morning, you'll see that actually we've analysed what we think will be the impact on each business. And perhaps not surprisingly, as Loans at Home is growing fastest, the impact is biggest in Loans at Home.
And what can you tell us about current trading?
The year started well, so the loan book growth we saw last year has continued into the first quarter of this year, and really importantly, impairment has remained under control.